So, good morning, afternoon, evening. I think it'll be probably afternoon, but good morning or good afternoon to everyone. And today, I want you to delve into a critical aspect of market dynamics, called the problem of imperfect information and asymmetric information. So I want you to start with that slide. Actually, the Patient Protection and Affordable Care Act, more popularly known as Obamacare, has become a controversial topic, one that relates strongly to the topic of this chapter. And so, before the ACA, like I want to call it briefly, in the like people often had limited information about healthcare plans. Insurers could deny coverage or charge higher premium based on pre-existing conditions, leading to asymmetrical information. So that's why it's related to our topic today. And people with health issues might not have been fully aware of the extent of coverage or potential exclusions in insurance plan. So, what does it mean actually? Imperfect information and asymmetric information. First of all, imperfect information, like situation case where either the buyer, the seller are uncertain about the qualities of what they're buying and selling. So I think the good an example of that relatable to our previous slide, it's like in healthcare, imperfect information is when a patient doesn't have all the necessary details about different treatment options. So this lack of complete information makes it tricky for them, both of them, to choose the best treatment, considering its effectiveness cost and potential risk. And, and you will ask, what's the difference between asymmetric information? So, asymmetric information is a situation or case where the seller or the buyer has more information than the other regarding the quality of item for sale. So, uh, so we have a lot of example in the next slide. And I think I will choose the most suitable for the asymmetric information. It's the last one, hiring a lawyer to represent your small business. So if you staying from the perspective of buyer, a lawyer might overcharge us for service or bill more hours than they actually worked. They might not represent their client as well as expected either. And if you're staying from the seller perspective, occasional clients may withhold key facts or circumstances that could be critical to the case. This might impact the lawyer's ability to accurately assess the situation and provide appropriate support. So, you'll ask why this information actually not imperfect. Yeah, it could be imperfect, and this is like in that ways, but I have an additional information for that. So imagine someone needs legal help and consults an experienced lawyer. The lawyer knows a lot about the law and can explain complex legal details, options, and possible outcomes. But the person seeking help might not understand these legal complexities as well because they don't have the same legal knowledge. So that's the point. And a lawyer might charge some additional price, extra costs, extra bills. So that's the point. So how we could reduce the imperfect information problem in that case. So, in my opinion, lawyers should maintain open and clear communication with their clients regarding to the number of billable hours. Encourage clients to provide all relevant information pertaining to their case, ensuring nothing crucial is omitted. I think it's a big problem right now in the US. A lot of migrants, or sometimes just in US citizens who are not even like a little bit into legal and law of the country are faced and struggling with such a problems that lawyers are charging extra bills and and what's the the funniest moment, lawyer gonna tell you about it in the end. So, how imperfect information can affect equilibrium price and quantity. So the presence of imperfect information can discourage both buyers and sellers from participating in the market. Buyers may become reluctant to participate because they cannot determine the product's quality. Sellers of high quality goods might be reluctant to participate because it's difficult to demonstrate the quality of their goods to buyers. Since buyers cannot determine which goods have higher quality, they are likely to be unwilling to pay a higher price for such goods. Uh, actually, so for me, imperfect information influence market efficiency by affecting buyer confidence, reducing demand for higher priced goods, and impacting seller participation. This imbalance influences both equilibrium price and the quantity transacted in the market. So actually, imperfect information can affect in any way of the equilibrium price and quantity in the market. So thank you.
Thin and thick markets. Some important points to keep in mind when we talk about thin and thick markets are that economists sometimes refer to the market with few buyers and few sellers as a thin market. By contrast, they call the market with many buyers and sellers as a thick market. When imperfect information is severe and buyers and sellers are discouraged from participating, markets may become extremely thin. In other words, thin markets only are focused with characterizing a market with few participants, unlike a thick market, which includes having many buyers and many sellers. The effect of having imperfect information will cause less buyers and less sellers, causing to have a very thin market. When price mixes with imperfect information about quality. For example, a buyer may assume that an expensive gemstone must be of higher quality, even though they are not experts on gemstones. In other words, a buyer is confronted with imperfect information. This will often lead to them going based off the price more than looking at the actual quality. Sometimes buyers will go into market and will be drawn more to the price reference about the product rather than the quality that could be in there. This can cause trouble when reaching an equilibrium. Overall, the idea is that if the price is higher, then the quality must be better. Mechanisms to reduce the risk of imperfect information. Buyers and sellers in the goods market rely on warranties, and service contracts to assure quality. The the labor market uses occupational license and certificates to assure uh, product. The financial capital market uses cosigners and collaterals as insurance against uh, the terminal events. In other words, to assure someone that they will be receiving a product and there will be no risk or as minimum of a risk, what businesses do and markets do is that they will try to find different services that they can offer the customer, such as a warranty, a contract, or having licenses to help the buyer feel more calm about what they are taking in. Money back warranty. When we talk about this, we mainly refer to the LL Bean, which started using money back warranties in 1911, when the founder was guaranteed satisfaction on newly branded hunting shoes. This goes back into goods markets, and sellers might offer money back warranty. This is an agreement that the function of a promise of quality. In other words, when we use this slide, the money back warranty, what we're referring to is that buyers and sellers will be able to relate back to any type of returns in product at any time and any conditions. This will allow the satisfaction of the customer and consumer and will continue to progress in business. But what is the LLB? Many firms today offer money back warranties for a few weeks or months, but LL Bean offers a complete money back guarantee. Customers will always return anything they have bought from LL Bean, no matter how many years later or what conditions the product is in, for a full money back guarantee.
So I will be talking about the goods market. Um, Sellers may often a warranty, which is a promise to fix or replace the good, at least for a certain period of time. A service contract is where the buyer, pays an extra amount and the seller agrees to fix anything that goes wrong for a set time period. Guarantees, warranties, and service contracts are examples of explicit reinsurance that sellers provide. And like a couple, notes to really sum it up. The goods market really refers to the market where the final goods and the service are bought and sold. It is a crucial, component of the overall economy, and it plays a significant role in determining the level of economic activity. Um, Besides all that, here are some good market tips on how it work. Demand and supply, price determination, role of consumers. Those all play a part of what the goods market opening are based upon principles of demand and supply. With price determination, the interaction between demand and supply in the goods market determines the equilibrium of price of goods and services. And like role of customers play a pivotal role in the goods market as they drive demand by purchasing goods and services. Okay, moving forward, we'll be talking about occupational licenses. The labor market also use occupational license to establish quality in the market. Occupational license show that a worker has completed a certainty type of education or passed a certain test. Also, with occupational license are the government issued by certification that grants individuals the legal authority to practice certain professions or occupations. They are intended to ensure public safety, protect customers, and maintain professional standards. Just like in the next one, some of the professionals who must hold license are doctors, teachers, nurses, engineers, accountants, and lawyers, which makes sense. Um, Occupational license have their downside as well, as they represent a barrier to entry to certain industries. The benefits of being occupation license can provide several benefits, including customer protection, quality assurance, and professional accountability. They can help prevent underqualified individuals from practicing in certain fields and maintain standards of competence and ethics. Some of the requirements are obtaining an occupational license typically involves meeting a specific criteria such as completing education or training programs, passing exams, and fulfilling experience or apprenticeship requirements. The requirements vary across professions and jurisdictions. With all this being, what I would like to say kind of great and everything, they always have, things that we go through and things that people may be opposed to, and that just like with life, everything has some things that we have to go through. So like some of the criticism is critics argue that occupational licenses can create barriers to entry and restrict competition and limit economic opportunities. They claim that excessive licensing requirements can be burdensome, unnecessary, and disproportionately affect low-income individuals or minority groups. Whew. Um, with that all being said, last but not least, the balancing act for occupational license are that customer protection with the potential negative effects of occupational licenses is a challenge. Policymakers must carefully consider the costs and benefits of licensing requirements to strike a balance that ensures public safety while promoting economic opportunity. Okay, financialness of okay, moving on to financial markets. In the financial capital market, before a bank makes a loan, it requires a prospective borrower to fill out forms regarding sources of income. In addition, the bank conducts a credit check on the individual's past borrowing. Okay, moving forward to financial markets. In the financial capital market, before a bank makes a loan, it requires a prospective borrower to fill out forms regarding sources of income. In addition, the bank conducts a credit check on the individual's past borrowing. A cosigner is another person or firm who legally pleads to repay some of all the money if the original borrower does not do so. Collateral is a property of equipment that the bank will have a right to seize and sell if the borrower does not repay the loan. Moving forward on that, a couple of things to add on to financial markets is the efficiency with it, the risk management, the capital formation, and the price discovery. And the efficient, with things in life we have to be efficient. So just with like this is something that is very big on when it's coming down to the word being efficient. So, financial markets play a crucial role in allocating capital efficiently by connecting borrowers and lenders, investors and issuers and buyers and sellers of the financial instruments. They facilitate flow of the funds and enable efficient price discovery. Risk management. Financial markets offer a range of instruments and products that allow individuals and business to make various types of financial risk, such as rate risk, current risk, and credit risk. These risk managed tools that help participants m- potential lose and protect their investments. The capital formation and the price discovery helps out a lot because of the fact that it is essential for raising capital businesses and governments. Through our initial public offerings and buying insurances, companies can raise funds to finance their operations, invest in growth, and create employment opportunities. Financial markets, going back to price discovery, provides a platform for buyers and sellers to determine the fair value of financial assets. The consistent trading and interaction of market participation contribute to price discovery, reflecting the collective assignments of marketing conditions and expectations. And last but not least, overall, financial markets are dynamic and complete systems that facilitate the efficient allocation of capital and provide liquidity and enable risk management. They play a vivid role in supporting the economic growth, investment opportunities, and wealth creation. To sum it all up, To sum it all up, many make economic transactions in a situation of imperfect information, whether buyer, seller, or both are less than 100% certain about the qualities of what they are buying or selling. In goods markets, buyers face imperfect information about products and may depend upon money back guarantees, warranties, service contracts, and reputation. In labor markets, employers facing imperfect information about potential employees may turn to resumes, recommendations, uh, occupational licenses for certain jobs, and unemployment for trial periods. In capital markets, lending faces imperfect information about borrowers may require detailed loan application and credit checks, co-signers, and collateral.
For this next section, we will be discussing insurance and its connections to the imperfect information problem. Insurance is a financial service that is meant to provide customers, uh, such as households and businesses, with financial and economic protection against unexpected events. An example of this is car insurance. If you have insurance and get into an accident, you don't have to pay the entire amount by yourself. It's meant to protect households and firms from having a single event cause significant economic damage. To get this protection, households and firms need to pay premiums, which are regular payments to the insurance company. The price is based on probability of different events happening as well as the magnitude of those events. When a customer is affected by an event that's covered by their insurance policy, they receive payments from a pool of money collected by the insurance firm from multiple different customers over time. Obviously, no one can predict the future, but we can use statistics to try to assign probabilities to the likelihood that specific events will happen. This is where the imperfect information problem comes into the equation. The likelihood of something happening can be estimated but not predicted by looking at a combination of people's personal characteristics as well as their life choices. To calculate the premiums, the insurance company will do its best to predict how many accidents and what magnitude they will be. In this example, 100 drivers have insurance. 60 of them won't get into any accidents at all, 30 will get into small to medium sized accidents, and 10 will get into major accidents. This will result in $186,000 in claims, which divided by the 100 drivers is $1,860 on average in premiums per driver. Um, and the number changes based on the probability that any specific person will get into an accident, which is calculated by these different uh, characteristics and life choices. Since insurance companies have many clients, they can also negotiate to get lower prices for these different uh, accidents, like with healthcare providers or uh, other clients. The insurance companies make their money by investing the pooled money that they've collected from their customers. And these investments, together with the premiums, are the cash inflows for the company, while the cash outflows mainly are the um, the insurance payouts, but also um, their expenses and profits and losses. As I mentioned earlier, people pay their premiums based on the probability the insurer deems that the person or firm will need a payout. This is called dividing into risk groups. And the riskier you are, the higher premium you will pay. Insurance companies will make groups, uh, they want to make groups actuarially fair, which is when premiums paid equal the amount an average person in that risk group would collect in the payout of the claims. If the um, groups are actuarially fair, the only profits the insurance company will make will come from investing the money. Uh, A problem with insurance is that it can lead to people taking more risk than if they didn't have insurance, since they wouldn't have to carry all of the consequences if something goes wrong. This is called the moral hazard problem, and there are a few ways to reduce its effects. For example, monitoring behavior and offering premium discounts for safety.
Ways customers pay. Customers pay through deductibles, which is the amount that policyholders pay before the insurance company will start paying. Customers also pay through co-payments. Co-payments are the policyholder pays a small amount and the insurance company will pay the rest. Co-insurance is when the insurance company pays a certain percentage and the policyholder will pay the rest. Incentives of healthcare providers. Healthcare providers can get a fee for service, which is when healthcare providers are paid based off of the services they provide. So if they provide more service, they get more from the work they put in. Or through HMOs, which is when healthcare providers are given a fixed amount per person, which gives the provider the incentive to limit the quantity of the care. Or there is adverse selection problem. Adverse selection problem refers to when the insurance buyer have more information over the insurance company because the buyer knows whether or not they are a high risk or a low risk customer, and the insurance company doesn't know that information. So buyers that are high risk tend to want to buy more insurance without letting the insurance company know that they are a high risk customer. For example, someone purchasing health insurance knows more about their family health history than the insurance company can find out. So if the person has a history of heart attacks, so poor cardiacs or diabetes within the family, the insurance company doesn't know that information. The U.S. healthcare in an international context. The U.S. is the only high-income country where private firms pay and provide for most of the health insurance. The U.S. spends more per capita on health care than any other industrial country. Outcomes measured by life expectancy and child mortality are worse than any other high-income country. The U.S. healthcare system provides high-quality care with relatively short waiting time for treatment. Other countries have more equal access, but that doesn't mean it's better, so they can end up getting lower quality healthcare. But yeah, they're still having long wait times. Government regulation of insurance. The U.S. insurance industry is primarily regulated at a state level. So that means federal level can assign a law or create a law, but it can be changed or altered at a state level, and the law can be slightly different. The National Association of Insurance Commissioners brings together the state regulators to exchange information and strategies. The state insurance regulators attempt to keep the price of insurance low and ensure that everyone has insurance. If premiums are set high, the premiums collected may not be enough to cover all the claims. If premiums are set way too low, the insurance companies might lose money and withdraw from the insurance market in that state. Government regulation of insurance. in some industries, the U.S. government has decided free markets will not provide insurance at an affordable price. So that is when the government will step in and pay directly. So that's where Medicaid and Medicare comes into play. Other common government intervention in insurance markets is to require that everyone buy certain kinds of insurance. State required car insurance is a really good example because in most states you must have car insurance. And mortgage companies require homeowners insurance. The Patient Protection and Affordable Care Act. In March of 2010, President Obama signed into law the Patient Protection and Affordable Care Act, or PPACA. PPACA. The goal of the act is to bring the United States closer to universal coverage. Prior to the ACA, more than 32 million Americans were uninsured. People who are uninsured tend to use emergency rooms for treatment, which has contributed significantly to the rise of cost. Summary: the fundamental law of insurance is that what the average person pays in overtime cannot be less than what the average person gets out. Many insurance policies have deductibles, co-payments, or co-insurance. In the fee-for-service health financing system, medical care providers receive reimbursements according to the cost of services they provide. An alternative method of organizing healthcare is through health maintenance organizations, otherwise known as HMOs, where medical care providers receive reimbursements according to the number of patients they handle, and it is up to the providers to allocate resources between patients who receive more or fewer healthcare services. Adverse selection arises in insurance markets when insurance buyers know more about the risks they face rather than the insurance company. So that's when the buyer knows more about themselves than the insurance company. So, as I said earlier about previous family health history, which is major in the insurance companies.